So first of all, just need to go through our disclaimer with you. Trading involves a loss of risk of capital. Trading is not suitable for everybody, although as usual, we hope it is for you. Many companies provide leverage, so just be aware you can lose substantially more than the initial investment you make. The news, opinions, everything contained in this is just purely for educational purposes. We are not trying to encourage you to trade or invest. That has to be your decision. And of course, you should carefully consider the risks involved, your financial situation, definitely your level of experience and your risk appetite. And of course, you should only risk capital you're prepared, but more importantly, that you can afford to lose. Any doubts whatsoever, seek independent financial advice before risking your capital, please. Okay, so last week, yeah, so much went on, especially from the central banks. Not so much data-wise, but definitely from the central banks. So it was all about them, and they certainly did not disappoint. Many increased by 75 basis points, but we did have a 1% from Sweden, 50 basis points from the Bank of England, and nothing from Japan or China. Even the Swiss hiked by 75 basis points, which took them from negative 25 to a positive 0.5%. Data remained weak. It wasn't much out, but what there was, and again, it's not really surprising with all these rate hikes. The USD continued to strengthen, driving the euro below par to the USD again, and the GBP, dropped below 110. These levels have not been seen for a long time, decades. And I'm a big fan of the dollar, and I have been for at least the last 2.5 years. But it's possible we could see a little bit of profit taking coming in soon. That doesn't mean it's the end of the dollar. It just means that, as I say, just a little bit of profit taking while everybody takes stock and works out what's going to happen next. Japan had to threaten to intervene on the yen to sort of give that a little bit of buoyancy, but the dollar's just still so strong. Of course, stocks had another bad week, ending on the lows. Gold too sort of followed stocks lower, trading below $165, and oil dropped below 80. Now I do expect, obviously just from reading and all that, I don't know, that the US will replenish their strategic reserves around these sort of levels below 80. Of course, we'll have to wait and see, but there is a really strong chance that they will do that. Okay, so key data for this week. Now, there's a lot of central bank speakers this week. Let's be careful how I said that. And of course, we're going to hear from their views on what they've done already, and what's coming up in the coming months. What they expect, and of course, all the focus is on inflation still. So in the US, we've got plenty of data this week. Watch out for consumer confidence. I've watched this really closely, consumer confidence. We account for up to 70% of an economy. So obviously how we feel about, our earning potential, what's around the corner for us as individuals and as households, family and friends, is going to impact the way that we spend. Now, we're obviously seeing higher prices. We've had less disposable income from food, energy, and such like. But the fact is that with all of this rate increases and all that, we're getting less and less to be able to spend. Now, that's why I like consumer confidence, because if we're not confident, we hold back. We don't spend so much. And of course, that's important, especially when, as I say, that we account for so much of an economy. GDP could be negative again with US already in a technical recession. I mean, for me, they've still got the strongest economy, but technically, you could say they're in a recession. Maybe we need to change economics and what the criteria is that says someone's in a recession or not, well, countrywide. But don't be fooled, you know. Demand is still there in the US, and as I say, they do have the best economy. Now, PCE. So this is one of Powell's main metrics, and because of that, you know, basically it's more stable, it's more reliable than CPI. So PCE is the personal consumption expenditure. Of course, it's a price index, but what we're looking at, are consumers spending more now short term, or are they holding back and saving more for the longer term? And you know, that's why the Fed likes that so much. In the UK, not too much out, but we've got housing data, but eyes will be on the GDP, obviously, to see if we're entering a recession for sure. I'm based in the UK, so that's why I say that. Truss has sort of cushioned it, cushioned the blow, I would say. They've just done a mini budget with some tax cuts and, of course, the power caps. You know, inflation is higher. I would still expect it to go a little bit higher yet, and then to drop back. But you know, that's only sort of my personal view. In the EU, we've got the HICP, which is effectively a CPI. We're looking at the change of prices there, you know, goods and services. But, you know, always watch for the core change. You know, don't focus so much on the headline, but much more on the core. That's the one that pro traders look at, because that's got the more consistency to it. And, you know, it takes away the tobacco, the alcohol, energy, and such like food. Retail sales, and then of course consumer and industrial confidence, which I would expect to be remaining low still. From Germany, we're going to get IFO, and of course that's for the business sentiment, in case you didn't know. And they survey over 7,000 businesses to get that data. And also in Germany, we're going to see retail sales and the CPI preliminary. You know, the EU is still trying to create this sort of energy cap. Some countries want it just for Russia, other countries want it to cover basically everywhere. So, you know, there's still arguments going on there. So, you know, it'll be interesting to see what the result of that is. Hopefully it won't take them too long to come up with something though. There's a little bit of minor data coming out, PMIs and such like in Japan, industrial production, retail sales, China PMI and manufacturing, and Australia retail sales. So I've added in the dot plot here. This is sort of every other meeting. This is what comes out after they have the FOMC meeting. Now, each one of these dots represents a member of the committee. You don't know who it is, but you can see from it the shape and the expectations going forward. So the dot plot there is leading up towards the end of the year on the left, the first block. And as you can see underneath the years, so the next one is 2023, the next one is 2024. So next year you're expecting rates to stay high. The year after, you know, the Fed's very mixed when you look at those. You know, the range there is incredible. It's like 2% between the highest and the lowest there. So some are expecting by 2024 that those rates are going to come down, some much more aggressively than others. And then 2025 for them to be a bit lower and to hold there, and then going further than 2025 to have sort of balanced out around there, you know, around the 2.5-ish level. But obviously things can change very quickly in the markets and economics at the moment. So, but I just thought it's interesting for you to see that if you're not familiar with it. Okay, moving on to the macro. Of course, inflation. So it's still the devil as far as central banks are concerned, and to a degree even us, the consumers. Although it is slowly dropping, which I expect to see start to feed into the PPI, but I don't expect it to be seen in CPI as quickly, because companies are simply increasing their profit margins even more while they can. Stagflation, that remains sort of this pre-recession condition, if you like, I think. Again, just my view. And for those of you that are not familiar, it's basically inflation but without growth. Recession-wise, as I keep writing in my daily newsletter, mentioned in our YouTube, central banks are prepared to create recessions by increasing rates and keeping them high. So don't expect them to come off anytime soon. They're not going to reverse policy quickly, and they will not stop until they have inflation under control at constant 2%. That doesn't mean they're going to keep increasing rates and rates and rates and rates, but what they're going to do is they're going to get them to the point where they feel that it's at a level where it's starting to reduce demand. That's the only part of the economy that they can try and manipulate and control is consumer demand. So in my mind, what they're trying to do is destroy that. And then once they've done that, that's when they can start to rebuild. We still have some supply chain issues, although again they're still improving. So we have seen quite a good recovery in all different directions since COVID, and obviously since Russia invaded Ukraine as well. And that's pushed oil back below $80 for the moment. Now, of course, the main risk is that China's zero tolerance for COVID, which has resulted in over 20 cities going into lockdowns. Now, of course, if there's any new increases in those, or any new cities where they're finding that, or of course any mutations that come along, that could again come back and endanger supply chains, especially from China. The Russia-Ukraine war continues, 7th month now. Who would have believed it? And of course, Russia now is calling up 300,000 reservists, if you can call them that, volunteers, but many of them are very reluctant to go and are even trying to leave the country rather than fight. And of course, Putin holds what he considered by governments around the world to be false elections, referendums, if you like, in the captured states near to the Russian border to make them part of Russia. And of course, last week he also threatened the use of nuclear weapons, I believe. Now, energy prices are well off the highs. We see them up to about 130, and here we are down at 80. And it's just really a matter of rebalancing there, I think. Europe's finding alternative sources to replace Russian energy, apart from obviously Russia turned off the gas taps. And Russia is exporting more to China and India and other countries that are prepared to take it, especially because of the discounts. And by the end of this year, Russia will have completed its new pipeline that goes into China for gas. Now, generally, because Russia offers that discount, it is attractive to countries, and you can't blame them for taking it, for sure. But by that happening, it does release other countries' suppliers to sell to those that have got sanctions against Russia. So it's just people moving around, or countries moving around, who they trade with, who they buy from. Really, supply and demand hasn't really changed that much. And of course, that weakness in the oil is where people are getting more concerned about demand again, because if these rates keep going up, if consumers have got less money, they're going to do less, they're going to go out less. And of course, if there's less transport needed in all different, whether it's industry or whatever, then that's going to reduce the demand. So that's becoming a nervous factor as well. With food prices, they've also dropped, but again, the weather is now again becoming that key impactor. And we have La Niña that becomes active. It's been active all this year, which is why we've seen these extremes in weather, and that's going to remain into next year as well. And that just does turn the weather topsy-turvy. And I believe that workers are beginning to return to work, and companies will, of course, soon be withdrawing some of those jobs as the risk of recession grows everywhere. Of course, we're just finishing September, so we're soon going to see third quarter GDPs, which will be really interesting. Now, next Tuesday, this Tuesday coming, the 27th, I've been asked to appear on Ninja Trader. They do these trader workshops where we discuss various things. So they want me to sort of give a brief outlook, brief idea of my career so far. It's only 50 years so far, so but let's see where, for that. I'm going to be brief on that, otherwise that'll be all the 45 minutes gone. And then we're going to talk about the macro outlook, and we're going to analyse a few markets as well. So I've put a link there just in case you want to come along and listen to that. It's only 45 minutes and it starts at 5 o'clock UK time on Tuesday. So trading tip of the week is just on technical analysis. It's more of a warning and everything. I've been mentioning this for you guys for the last weeks and in my newsletter for absolutely ages. That when you're looking at charts and all that, and you're trying to put in solid lines of support and all that, if it's not genuine, if it's not solid, don't make it up. It's going to cost you money. So, sometimes I struggle to find a support line or a resistance line, and I would rather leave it blank than to put something in that is not a solid line, not a genuine line, because I don't want to be trading at those types of levels, because generally they're not going to work. So you've got to be able to identify them. And obviously with the pound and the euro keep making these fresh lows, it's very hard to get support lines sometimes, but it's telling you something. Be careful about buying it. As I say, I've been warning about that. So just be careful with these markets. They're very, not dangerous at the moment, but they're very bearish, the majority of them, apart from the dollar, of course. So just be aware of that. Just be very selective with those trades. Okay, so now we're on to the second part, which is our technical analysis. Just a reminder, so black numbers in the right hand are support resistance levels, or you may find one or two just for the closing prices of the week. Brown numbers are breakout levels. We're not seeing too many of them on the upside at the moment, that's for sure. And the claret numbers are just horizontal, where I've either identified a bit of support or resistance, or I've managed to find double or triple tops or bottoms. I have got some Fibonacci in this week, so just be aware of that and what those levels are. And because they are coming a bit more into play, especially with the stocks. Okay, so obviously stocks were trading lower during the week, especially towards the end of the week. And that's just, in my mind, just central banks hiking rates, talks of recession. Companies are performing well, but a lot of them at the moment, because obviously their profit margins are up. They're the highest they've been for decades, over 15%. And some of them probably at the moment are getting even more than that, just because raw materials have come down, power's come down, but you haven't seen those prices in the shop come down yet. And of course, as the buying backs away, as the recession starts to bite, then companies are going to be forced to drop those prices down. Okay, so with the Dow Jones, on this one, all I've simply put is just the Fibonacci. And, it just helps that, when we look back, it's sort of just left of middle. You can see that sell-off that happened around about March 2020 when COVID first hit. We had that amazing rally up with all that quantitative easing that was being done by the central banks. And then, of course, as that stopped and reversed, you're seeing the market lower and lower. We are still getting some of those peaks. It's not all one way, but for me, the peaks have been an opportunity to sell rather than the dips, an opportunity to buy. But just be careful, because I'm a natural bear trader anyway, so these markets really suit me. Okay, so let's move on to the next one, which is the 30-minute. And on there, I've managed to find resistance at 29,961 and 29,880, with support at 29,287. It's still a down channel, you know, not deep, and of course where it's closed is in the middle of that channel from what I can see at the moment. So just moving on to the S&P. So there's the daily again. So I've managed to find a resistance level at 3,900, which is obviously away from the market at the moment. Support I've got at 36.36 and 35.43. There's another one, but it's much further down, and if it gets there, we're really in trouble. So I hope it doesn't. Okay, so again, I've added an extra slide here. So this is the S&P with the Fibonacci's on. As you can see, you know, we're through the first level, the 382. We haven't got to the 50 level yet, and certainly nowhere near the golden ratio. But they are coming a bit more into play, which is why I've put them on. So just, you know, be aware of them, and just make a note of them, and just, you know, that they don't really move each day because they're set from the lowest point to the highest point. And that's an important thing because, you know, when you're doing the analysis, it's only where I've put that vertical blue line in, it's you can only analyze the data to the right hand side. I'm always mindful of what happens on the left hand side, but you know, when you're looking at those particular Fibonacci levels, it's much more important to be looking on the right hand side after it's peaked there to what's going on to help you with those levels. And of course, always remember, you know, if a support level is broken, it effectively becomes resistance. If a resistance level is broken, it effectively becomes a support. You know, for me, I always wait until that candle closes, whether it's a daily or a 30-minute or whatever, because I want that confirmation. Because, you know, you sometimes you get these false breakouts and you need to be careful with them. And moving on to the 30-minute. So here we are. On the 30-minute, I've managed to find some resistance at 37.26 and 37.16 and support at 36.53. Nasdaq, so on the daily, you know, again, stocks just full of stocks at the moment, so it's just some move a bit faster than the others. So on the daily, I've got resistance way above the market at 13,245, and then 12,896 and 12,200. Support at 11,388 and 10,653. On the 30-minute, I've got resistance at 11,598 and at 11,398, which is very close to the support on the daily. And then below that, 11,200 for the support on the 30-minute. So, you know, some of these levels are definitely going to break each other. Moving on to the Russell, which are the small and mid-cap companies. So on the daily, 1880 resistance and 1788. Support at 1687, 1524 and 1449, which are obviously quite some way away. But, you know, they're always ones just to jot down because they could come into play later on and they're not going to change. And then moving on to the third, there we've got we're close to the resistance level on that one of that downtrend line there at 1689, which again is very close to the support on the daily that I mentioned just now. And then the other support on that downtrend is 1657. Now, moving on to currencies, you know, with dollar strength and you know, what's been going on in the UK and you know, sort of in Europe, really, with all these high energy prices, power prices, food prices, inflation in general, it's had a massive impact on us. And as we're seeing, regardless that the fact that, you know, we may sort of be turning the corner a little, currencies are really still under pressure. And so for that, I've had to move to a monthly chart, not a daily, so you could appreciate this. And on that, I have managed to find, you know, the resistance is way up, it's at 120. but support I found was at 109.75. But you know, I expect that to be broken immediately. Well, obviously, unless there's a bounce over sort of pretty much sentiment of the weekend. And then when we move on to the 30, forget the one way up there, but we can look at sort of 108.84 as a resistance. So as I say, on the on the monthly, it's above that, and on the support on the downside, 1.0840. So you know these levels have not been seen for decades. And so again, you know, this comes back to if you can't see a level, if you can't find a support line, don't try and add one. But you know, I've managed to find what I think are reasonable ones there, which is why I have. Now, moving on to the euro against the dollar, and here, you know, obviously the euro remains under pressure as well. And again, I've had to go back to the monthly. Now, this monthly goes back to the actual inception of the euro as a tangible currency, a fiat currency, back in 2001. And you can see these sort of levels have not been seen since then, you know, on that big move on the upside. And again, it just brings it home to you on sort of how much pressure there is on the euro and the pound and how much strength there is in the dollar still. So on here, I've got resistance at 1.0355 and support at 0.9585. On the 30-minute, I've got resistance at 0.9913 and 0.9850 with support at 0.9721. You know, again, just be a little bit cautious. You know, I said earlier that I expect maybe there's going to be a little bit of profit taking coming in because, you know, they really did have a push towards the end of the week. But, you know, it's justifiable when you see the, you know, the aggressive rate increases coming from the US and the strength of their economy versus the rest. So moving on to Bitcoin, which, you know, I was surprised. I think it had sort of quite a good week, really. And, you know, resistance, 23,280, support just over 18,000 at 18,036. So, yeah, for me, it's holding in quite well now. You know, I think a lot of the panic selling or the you know, the really people that needed to liquidate their crypto to release capital just to even pay their bills and such like has probably sort of finished for the moment. I'm not saying it's finished completely. And moving on to the 30-minute, I've got resistance at 19,495 and also 18,897 with support at 18,563. Now, I always like to add in this one, and usually they're very loosely correlated. But as you can see, you know, this past week hasn't been so closely correlated. The stocks have been coming off much faster than Bitcoin. And you know, just keep an eye on that. You know, I'm not saying it's one to trade, but it does sort of give you just a little bit of insight. So, you know, for me at the moment, that correlation has become much looser than it actually ever was. Moving on to gold. Again, you know, during the week it tried to steady up, but the bears on Friday just came back in and pushed it lower and ended up round about 1635. So you know, support and resistance. I've got resistance at 1709 and 1679, and I've got support pretty much where it closed at the 1635. Now, if I put it on the 30-minute and look at that, then I would say I've got resistance at 1665 and 1656. with support coming in a little bit stronger, possibly around about the 1646 even. Again, that's going to break out one way or the other for sure, just because of the volatility in the markets. And definitely last but not least, we're on to oil. It spent the most of the week in a sort of a $5 range between 81 and 86. And then again on Friday, dollar strength came in. Pretty much everyone had finished sort of assessing central bank actions for the week. We saw some fresh selling coming in, which took oil below 80. I think it just about touched 78. But as I mentioned in the analysis earlier, sort of the macro bit of it, it's expected that the US will start to top up their strategic reserves while it's below 80 or around 80. So, I'm not saying that that's going to cushion it or stop it going lower, but in my mind, it could hold it there for a little bit longer. Whether it finds some support there and then drops again, I don't know. Or whether it's just going to keep going down, or whether it's going to have another bounce back up to the 85, 86. That's part of the fun of trading oil. It's one of my favorite products, although I tend to trade it much more with strategies, calendar spreads and such like. Again, if you've got any interest in learning any of this stuff that you don't know, then reach out to us because we're happy to help you. So finally, on the 30-minute, I've got resistance at 82.32 and 80.12, and support at 79.02 and 77.59. So I hope you've enjoyed the sort of macro outlook that I've done and the analysis, a little bit about our services and what we do. Just as a reminder, we do a daily newsletter which includes all the global news, my views, fresh daily chart levels, fresh daily pivot points. So sign up for it. You get a free trial, and it's really not expensive. A monthly fee is £35 after your free trial's over. You can't even get a coffee every couple of days for that. Workshops, we do one-day workshops which help you sort of fill in any gaps that you've got with your trading. We do 1 week intensive courses to really sort of start your career rather, in a really solid way. We do some theory, we do practice. We really start to give you those solid foundations. And then if you want those really solid foundations and going much deeper into everything, then we've got our accredited masterclass. And of course, that could even lead to a job offer from us. Now, if you have any interest in them, then just reach out to the emails at the bottom and we will get back to you. We also do trader mentoring. So if there's any areas, and we do that an hour, half day, full day, etc. Or if you're doing one of these trading competitions even, to try and get a funded account, we can help you with that. We can help prepare you by giving you some good advice and showing you maybe a few things to help you set you on your way and hopefully to pass those challenges. We do consulting to companies, helping them obviously to hedge their risks that they've got in these markets. And we provide trader education to exchanges, to brokers, and of course, hundreds of individuals. To contact us, info@symaxfintech.com, or if you've got anything that you would like to direct straight to me, then it's chris.tubby@symax-int.com. Thanks for watching and really look forward to seeing you next week. Have a great week trading. Bye for now.